Hello and welcome to the Energy Talk podcast. My name is Olubunmi Olajide. Here we tell stories about Africa's energy transition, focusing first on the financiers, operators and policymakers that are pushing us towards a sustainable energy future. On this episode, we're covering the REPP facility, which is the Renewable Energy Performance Platform, and it is a private debt fund designed and managed by Camco to finance building the African grid of the future. The fund looks to mobilize close to 800 million over the next few years. And today we're speaking with Ben, who is the fund manager of the REPP fund, and Ieva, who is the former head of REPP technical assistance facility. They'll be sharing insights behind the fund's blended finance structure and their plans to invest in different asset types across the continent. As always, we'll start with our guests giving us a quick intro and then getting into the facility. If you do find value in this podcast, please do recommend it to a friend or colleague. And without any further ado, let's jump right into the introductions.
So my name is Ieva Indriunaite. I'm the Policy and Market Development Lead at Camco, based in our Nairobi office. And my journey with energy probably started from a personal interest quite a long time ago. So I come from Lithuania, which is a small country in East Europe. And so energy security was my first interest, but I think quite soon I picked up the passion for the interlink between the energy and sustainable development within the sort of climate policy space and climate finance. And this is what brought me to Camco ultimately, 5 years ago.
I'm Ben Hugues. I'm a director at Camco. I've been in this sector since 2012. My interest was to work in the renewables finance field. With my skills and my background, it made me look for a role in the African space. Also just like Ieva, very interested and curious about economic development and geopolitics as well. And so this kind of blended all these topics into one job, which has been a fascinating adventure so far for the past 12, 13 years.
Excellent. So who wants to take the lead and just give a brief background on Camco as an organization and the goals that you want to achieve there?
Well, Ben has been here longer than I have, so maybe he can kick it off.
Camco is the climate and impact fund manager. We are headquartered in London with offices in Nairobi, Johannesburg, Helsinki, Sydney and Auckland. We've been in this space, like I said, for a long time now, but as a fund manager, we started this in 2014, 2015. And our goal, our objectives has always been to be the best climate and impact fund manager, specifically for renewables in emerging markets. Over the years, we started with managing the REPP mandate, which was a mandate to finance small-scale renewables in Africa. And now we are managing 4 different strategies, and we've grown our AUM as a fund manager. We've grown the team as well. There's about 30 of us spread between the offices that I just mentioned. And Camco is just a bunch of very motivated people, very curious and passionate about the field of climate and impact, specifically in emerging markets. So the next few years, we'll be looking to expand what we've been doing for the past few years and doing even better and at a larger scale to increase our impact.
Yeah, I think what really comes out with Camco is the passion that Benjamin mentioned. I don't know if it's the way that we select the people, but everyone is super committed to the mission and to working together and innovating together. And I personally, although I've been with Camco now for 5 years, but I've always found it to be quite exceptional. Really enjoying it.
Thank you both for that background to Camco. And like you said, it's a very passionate team that you work with. And I want to just dive directly into it. At what life cycle of the REPP fund, Ieva, did you join the team? Were you there for the entire run of that fund?
No, I wasn't. I joined around 2021. So I suppose the fund was already, fully operational, sort of around the middle of its deployment lifetime, investment lifetime. And it was at the time when it was felt that perhaps Camco and REPP at the time needed a bit more focus on the sort of policy and market development and kind of enabling environment kind of work. And this is how my position came about. But Ben was really there from the very start, I think, the concept and the design and getting it up and running. So he knows it inside out as well.
Yeah, I know. So before we get to Ven, because Ven might obviously Ven, this probably is your baby. So Eva, when you came on and the additions that has been made for between the REPP 1 and REPP 2, obviously on the technical assistance front, was it as obvious at the time that that was an addition and needed to come in? Because a lot of times people just see this as a financing issue. They just have to solve the financing part. So how did the technical assistance component develop, especially going into the strategy for the second fund?
Sure. Yeah, it's quite interesting. I mean, there are probably not so many fund managers or impact investors that would have a dedicated role to a sort of policy, regulatory aspect. I have been advising the team on assessing those risks in our deals, but also really taking it a step forward in some of the key markets for us in trying to advocate for the enabling environment for regulations, particularly in the energy access space, to be sort of more investor friendly. And at the time, I think, what we pride ourselves at Camco is really being on the ground and kind of getting our hands dirty, basically, in the development of the projects, but within the financing of projects to really, helping those developers get to the financial close. And so it's quite a long journey. And we realize that, yeah, we work within an ecosystem. Energy access, energy more broadly, is a very highly regulated sector. And so you cannot work in silos. And in a lot of these markets, there's some additional support that's necessary. So we started that journey with REPP 1, but on a much sort of smaller scale. And as we move into REPP 2, that realization, both about the need to work with governments and sort of share the private sector perspective on what is necessary to really enable capital mobilization, but also on the need for early stage project financing. Those are two aspects that are intertwined in the way that we implement our market development facilities, and specifically the REPP 2 technical assistance facility. And that's what we have expanded moving from REPP 1 into the REPP 2 mandate. So Ben will, of course, talk a bit more about the REPP 2, but you'll see that because we're still at the forefront of everything from innovation in business models, innovation in financial structuring, working in markets where regulations are just not quite there yet, you really do need to have that additional support that can help you get across the line and help those investments reach financial close.
Very well said. And then switching it back to you, and I know that in terms of the size of the facility, REPP 2 is targeting a close of $250 million. Can you give the audience, in terms of scale, how much of a scale up is it from the initial first fund? And maybe you can start giving us some of the anecdotes from the fundraising journey.
So REPP 1 was $120 million. So REPP 2, we're targeting $250 million. We've already reached first close on REPP 2 in December of last year. So we raised $185 million with a mix of commitments and conditional commitments. So yeah, so we're looking to double essentially the size from between REPP 1 and REPP 2.
So this would make it one of the largest funds on the African continent that's targeting renewable energy projects. Was that the intention setting out? And how much of that is drawn by the evidence you saw from the first fund, the kind of projects that you financed through that first fund that influenced the ambition to scale up?
Yes, of course, that was based on our view of the market and our pipeline. So with REPP 1, we've managed to build up a very big pipeline of potential investments, not all of which we were able to finance with REPP 1 because we were bumping against the fund size practically. And so that's why we decided to raise REPP 2 and to increase the size of REPP 2. As you know, it's a very big market, a lot of opportunities. Now it's all about how we work on those opportunities. I think the status quo is typically to wait for an investment to be perfect before starting to engage and starting to work with the developers on finding ways to finance their projects. That's not our approach.
Yeah.
At Camco, we're much more practical and proactive. So we try to help the developers to find ways to get to a project built and operating. And so I think that opens up a lot of potential opportunities in the market. Specifically with our REPP 2 TAF, we are able to come earlier in the project's development phase to support the developer, get them to financial close where the REPP 2 fund can actually invest in for the construction of the projects.
And I'd like to get into the TAF component that you mentioned. Yeah, but maybe you can take us in there as well, because one thing that I've seen from Camco in general, as Ben kind of alluded to as well, is that you're not shying away from projects being in the messy early stages, because a lot of the more developed markets when it comes to renewable energy in Africa obviously is the solar project. So those ones are a lot more mapped out. We have larger CNI projects, but you're looking at projects outside of the solar space. So I just want Eva to speak to that a bit, that early stage support.
So on the early stage support, as Ben was mentioning, with the TAF, we're able to come in to provide some early stage project development support. So that's really at the kind of feasibility stage, with then the fund coming in later with the possibility to both providing late stage development loans and then construction capital. And I think it's very important, for us to both allow us to develop the relationship with those project developers and those off-grid companies that we're working with, to see how the project is progressing, and then hopefully come into the full-scale sort of investment. So the TAF is really an integral part of that, but it's really designed to support the theory of change of REPP2. And it's designed also in its governance to serve the fund, basically. So primarily focusing on developing that pipeline, whether it's helping, some short-term deals really just get across the line, or whether it's focusing on that earlier stage development. So we're quite flexible, actually, in the type of support that the TAF is able to provide. But a lot of it, as Ben mentioned and as you alluded to, is required for that early stage project development. So more of that TAF funding is going towards this type of support. But we have a governance structure whereby, the TA is available still to projects that are sort of firmly in the REPP2 pipeline. So we work very closely between our market development team and the investment team, and sort of pulling both of these, expertise areas together in trying to help our future investees get across the line.
And Ben, something very interesting when I hear this is, apart from the financial investment, this sounds like a lot of hands-on time that's been put in by the rest of the Camco team to your potential investees, which I'm guessing might not in all cases convert to a final project investment. So how do you balance this, trying to find viable projects to make investments versus being more hands-on in the developmental stage?
Yeah, so in REPP1, we were doing all of this within the same facility. But our approach for REPP2 was really to split the fund itself and then the TA facility. So now we're able to, thanks to our funders, we were able to capitalize the TA facility with $5 million. We're looking to double this up to $10 million. And that budget and that financing can go specifically for spending time and providing resources to the developers during the development phase. So it means we are able to somehow have a bit of that split between the development phase with the TA and then the construction phase with the REPP2 funds. Now, we are still, even with the REPP2 construction fund, we still end up putting a lot of effort and time on helping the project developers to structure their projects, their financing, and to crowd in other investors into the construction. That's something that we do, but that's, to us, we see this as being the only way to get project to close and to get it built. Obviously, some developers need more support than others. Others can do that work perfectly on their own, but a lot of them do need, a proactive partner alongside them on the financing side.
To add to what you were, I think, kind of alluded to, it was actually part of the design of the TAF strategy. So, first on the point of sort of splitting those two up, of course, REPP2 is a blended fund. And by having this separate TA facility, that allowed us to then create a structure and attract some of the funders that would be interested specifically in that risk sort of profile of that the fund was targeting, with the TAF being separate to it, but absolutely integral to it. And when we were discussing, the design of the TAF, it was, of course, there was a question of at which stage the TAF should come in, and the risk that if you come in too early, the investment, as you were suggesting, may not materialize. So we decided to sort of landed on the approach where you still need to pass, typically for most of the TA support, you would need to pass the first stage of the investment process, but admittedly, it is quite early stage. So we basically decided to take the risk that some of these projects could ultimately, not materialize, because that would have also a broader market development impact, which was for us quite important. I think, as Ben was saying, everyone is after in these markets the deals that are ready made, and we just feel that there's a bigger sort of area to play with that's outside of that, and we wanted to contribute to that as well.
Very well said. And more to that point, there is a trend that I'm seeing where, and maybe you can correct me if this assumption is wrong, where a lot of the projects that might be in the bucket of being more shovel ready, if you will, more ready for investment, they have the project financing team in-house, they can structure the transactions favorably to whatever parties are involved. But when it comes to developers that have local teams, local founders, maybe they have just core engineers and they don't have a lot of the financial knowledge, that is where a lot of that support is needed. So are you seeing the same trend show up as well? Is it mostly the local founders and the local companies that require more of that support in order to get themselves to the level where they can be more investment ready when it comes to their project portfolios?
I can start, Ieva. It's a bit of that, but not one-to-one. As in, it's not. We also come across local developers who are top-notch developers and don't really need the support, or can really get to a close without our help. And we've also seen non-local developers who are perhaps much more on the technical side. So companies that, for example, have built projects in Europe and are operating projects in Europe, but they've never developed or raised financing for projects in Africa. And so they need a bit of support there and knowledge sharing in terms of how to structure a deal in an African context.
Exactly. I think, Ben, I would have said, the only thing I would add is that sometimes it's really important what mindset the developer has. And if we are aligned on the mindset of being, effective, developing a strong working relationship and having sort of a single goal between the two of us, then, that's what really drives progress and drives us to the financial close faster.
That is a very good answer. Very well said. And moving now towards the structure of the fund, as Ieva pointed out earlier, so this is a blended finance fund, and obviously that would affect the way you go out and raise money, kind of projects you invest in, and the kind of exits that you look for. But I just want to start from the fundraising part of it. How easy was it to go out, both for the TAF and for the investment vehicle, to go out to capital community and have that conversation about doubling the size of the fund and scaling up the success you saw on the REPP one? Was it something that was immediately easy to understand and easy to sell, or did you face any challenges in the fundraising stage?
Do you want to start with the TAF, Ieva, and I can take over with the fund?
Sure. I mean, so the TAF is separate from the fund. I think and the funders are actually, at the moment, they are not the same as the investors in the fund. I think it's much more of a sort of common practice for a lot of our fellow fund managers to be able to raise that kind of grant capital for their technical assistance from the LPs in the fund. In our case, that might still be the case for the second 5 million. But for now, we have benefited from the support of NORAD, so the Norwegian Development Agency, and subsequently also from the Korean Development Agency. And I think NORAD was really the organization that came in early on. And they really shared our vision of supporting that early stage project development, supporting companies that are perhaps smaller scale and have a bit less experience, and to really provide that financing that will then catalyze the fund. So it's been great to work with them, and great that they sort of aligned with our vision, basically.
Yeah, perhaps so on REPP2. So we, like you said, it's a blended finance fund. So we've got 3 tranches. We've got a junior tranche, a senior tranche, and then let's call it a super senior tranche, each with a different level of risk and return and concessionality. As you can imagine, the junior tranche was the most difficult one to raise for, because that's the one that takes the most risk and the returns are not commensurate with that risk. So it's almost a tranche. Interestingly enough, for a long time, we were chasing NORAD with that tranche. And then when they told us that they wouldn't participate in the actual fund, the silver lining was that they were going to participate in the TA. So to anyone out there who's fundraising, never give up. And there's always a silver lining out there for the connections that you make, even if it's not the outcome that you expected. So yeah, the securing the most junior investors was the most difficult one. So Camco is an accredited entity with the Green Climate Fund, the GCF. We started working with them, I think 3 years ago, 2 or 3 years ago, on this REPP2 concept. It took a long time and effort and convincing to get the GCF on board with this. We also worked with the REPP1 board and the original REPP1 funder. So that's the SCDO, the British government, in parallel to the GCF. Once we had secured the GCF and the REPP1 SCDO commitment to the junior tranche, the conversations with the investors coming in the more senior tranches was much more difficult. There's definitely an aspect of senior investors waiting for the fund manager to secure the most junior tranche first, and then starting to be really putting more work into assessing the opportunity. So that was very the logic. So one junior tranche secured, then the senior investors, and then once we had one senior investors interested in making commitments, then that kind of unlocked also the super senior investors, who are the investors with the lowest risk appetite. And so they tend to wait for the more junior tranches to kind of be filled in, or at least, hard commitments before engaging. So that was kind of like the cascading effect of as part of the fundraise.
I want to break that down, but before that, I just want to draw back to the silver lining that Ben mentioned. And Eva, how important is it to have separate funders designated for the technical assistance facility component of this? Is this something that makes a substantial difference? And I ask that because a lot of impact funds, a problem that they do face sometimes is when the two get put together, is it really slows down the investment side, and then the technical assistance side is so like restricted by what they can do, because they can only do it for opportunities that can move on to those investments. So how much of a difference does it actually make having the LPs in TAF being different at this stage, at least from REPP2?
Interesting question. I'm not sure that I would make that difference. I mean, in our experience, we are still in conversations with some of the REPP2 investors to see whether they would like to contribute to the TAF. And I think we would very much welcome that contribution. Of course, the TAF is, as I mentioned, it's very much geared towards developing the fund. And so the fund's pipeline. And so it's, of course, in the interest of those organizations. The only thing, and I'm not exactly sure what you're alluding to. It seems like there are things hiding behind your question. But in our case, I think the two things that have definitely worked to our advantage is that with NORAD, we were able to enter this partnership a year before the fund reached its first close. I mean, at the time, we were perhaps hoping that we would reach the first close a little bit sooner. But also, it was great that they allowed us to start that work a bit earlier and to start actually, developing some of the relationships, developing early stage pipeline, even before the fund reached the final close. So over first close at the end of last year. So we were well set up and running with the TAF by the time the fund, came live. So that was really great. And I guess it would have been different if we were reliant only on the same funders, because they would have waited to close the investment before the TAF funding would have been made available. So that's definitely an advantage. And another one is that, well, it really depends on, who might be providing the technical assistance funding. Without singling anyone out, I think we know that some of the funders who also have the sort of grant funding available for the TAF, they have quite specific and sometimes restrictive requirements as to what the TA can be deployed to and also how it has to be managed. And we really wanted to have a flexible TAF. We know that this is what the market has been telling us as well, that developers like to, for example, often select their preferred service providers for the various studies that we are supporting, etc. So we try to allow for that flexibility. And this is what, the funders that came into the TAF, this is what they were also helping us to achieve.
And I think the next point is going to show a lot on that flexibility point. I think the best way to dive into the different components of REPP2 is to just walk through. So let's say there is a developer approaching your team and wanting to develop. I understand that you do like a multitude of asset classes. So it's solar, wind, even some hydro as well, on-grid and off-grid. So what does the start of that engagement look like, and can you walk us through what that scenario look like all the way to to the financial close for the developer? So not sure how you want to split it. Maybe makes sense if Yella goes first, or Ben, you can give that walkthrough.
Yeah, sure. So we have a 3-stage process in an assessment function. We first have what we call a concept note, which is presented to our investment committee. So what we do is that we start the conversation with the developer. We sit down with them, understanding the scope of the project. What is the ask? Where are they at in the development phase? We then and that can take a bit of time. Oftentimes we get developers who come for us for financing, but they don't really know what they need. So that's already part of the discussion is, okay, this is what we need, and this is how we can go about it, just at a concept level. Once we've got a good concept, we then present that concept to our investment committee, which is formed of Camco members, but also independent members. If the investment committee approves, we then start discussing in more details the terms of our financing with the developer. So that's, in terms of the pricing, the tenor, the conditions, and the financing. In parallel to this, once we've got the heads of terms approved, we start preparing what we call a structure paper, where we go into much more detail into our analysis of the risk and return profile of the transaction, the fit with the portfolio, any conditions to the financing that needs to be attached to it. And then we present the structure paper to the investment committee. What comes out of the discussion with the investment committee is oftentimes tweaks in the financing or recommendations in terms of additional conditions or different structure in the way the project financing is set up. Once we've got that approved, the term sheet is issued, and the term sheet and LOI is signed by the developer. So that is kind of a pre-commitment we together towards financial close. Once the term sheet and the LOI is signed, that's when we start our due diligence. So due diligence, we do technical, E&F, legal, commercial due diligence mainly. Depending on the project and the technology, obviously, sometimes it's a more legal due diligence or more technical due diligence. We do a site visit. Once the due diligence is approved, we then present the outcome of the due diligence to the investment committee, and that's the final approval. And once this typically final pack goes with the full draft of the financing agreement. And that's once this final approval has been obtained, we then obviously sign the agreement and then disburse once the milestones have been met.
Thank you for that. And something you didn't mention as well is that there is an equity component to REPP 2. And perhaps it's a smaller part of the overall facility, but how do you look at equity specifically to the projects that you decide to finance?
So, like I said, REPP 2 is largely a debt fund, but we've got the nice thing with REPP 2 is something that we were doing with REPP 1, we really wanted to replicate, was to have the full palette of financing available to us. So we can do all the way from senior debt, junior debt, but also hybrid equity types investments. And for an equity, obviously, product, we look at it a bit differently from the debt products that we offer. The pricing is obviously different, but also the risk profiles. And we're willing to take a bit more risk because we're not senior in the capital stack of the actual financing. Because we take a bit more risk, we also expect more rewards. So that can be, more returns that can be reflected in the pricing of the hybrid equity financing or in terms of the potential upside. So, if the developer project is doing very well, then we most likely will have a share of the upside proportionally to our contribution, obviously, which will give us the upside as a quid pro quo for the risk that we've taken from the start.
That makes a lot of sense. And the final question on this particular topic is, once you have made investment decisions, you've deployed the capital, how long are you looking to hold those assets, and what do your exit scenarios look like?
We can extend loans for up to 70 years. So we have a big range starting from loans which will be repaid or equity products repaid within 2 or 3 years, and loans that can be repaid within 15 or even 18 years. It all depends on the asset class. So obviously, whether we are financing a pure grid project or mini grid portfolio project, that will be typically at and below 10 years. And if we're looking at the small IPPs with a 20-year PPA, then we can extend that to 15, 17 years. Some mini grids, isolated grids, they go above 10 years if there is, the structuring behind that can secure the cash flow.
Very interesting. Good to see the long-term view as well on these assets. Moving on to the challenges that you're seeing specifically, and I want to focus on the earlier part of this, so the TAF component. Ieva, what are you seeing as the biggest challenges that you're hearing from the developers? Because I imagine that part of the engagement is a lot of listening as well. So what are people saying is the biggest challenges for them as developers trying to get projects deployed?
Well, it depends on whether you're looking, I guess, at the IPP market segment or the mini grids and isolated grids, so the sort of energy access space. And it's fair to admit that, in my role over the past 5 years, I've definitely focused much more on the mini grid and the broader sort of energy access space. That is very much, the market segment that is still in its early, I would say, development stage. There's a lot of innovation. There are a lot of opinions. There are a lot of different policies. It's of course a very regulated sector, and governments have a different view as to how they want it to develop in their countries. But that has been really one of the most challenging factors to developers. If we leave the financing aside and the different types of capital that are required from early stage to later stage to, construction, corporate equity and debt. But looking from my perspective and on the sort of broader market development level, regulations and the efficiency of these processes. So both the kind of, what's actually in the document, are the regulations able to provide the securities that any investor would be requiring, given that it's a long-term infrastructure investment? That's the first question. But the second question, are they being implemented on the ground? Are they being efficiently implemented, and are they actually being implemented? So that's something that, everyone will probably mention as one of the key challenges, and because it remains so. And it just highlights how we cannot be working in silos. This is a sector that requires very strong collaboration, and it requires all these different elements, from the enabling environment to the financing, to project design and development, and ultimately also the affordability question as well. So, the grants that may be allowing the projects to offer the affordable tariff to their end users, all of these are very closely interlinked. And unfortunately, the challenge is that often these different dimensions are still working in relatively strong silos and working at different speeds too. And so, when you can have a developer coming to us and, asking for an investment. They need to secure their permits. They also need to secure the viability gap funding, and all of these bits might be moving at very different speeds. And this is what ultimately slows down the investment too. As a fund manager, we often get asked, one of the first questions from any developer is often, how long does it take for you to approve your funding? And this is such a difficult question to answer because, of course, Ben can tell you how many stages of approval we have and how often our investment committee meets. But it's really not that defines the length of taking a project from the initial engagement to its financial close. It's a lot about when, the developer will have all the different elements in play for us to assess the deal and structure a deal and then ultimately close it and get it built. So that's one of the challenges, or several of the challenges, I guess, that exist.
And one more thing before we move on, I'm very curious what your take is on the market in general, because there's a lot of incentive financially wise with subsidies and grants available in the mini grid space specifically. Let's keep it to that, where we're seeing the potential for a lot of companies to rapidly scale up their operations. And obviously that comes with the normal growing pains an organization will have. Are you seeing and hearing anything interesting particular to that as well? The companies trying to scale up operations?
Interesting question. And maybe Ben is actually better placed to comment on it. But it's true that, something that we noticed sort of around the end of the REPP1 deployment period was that there were a lot of different viability gap programs, or sort of whether it's RBF or different types of support coming up across the African continent. And multiple developers were trying, of course, to both, I guess, diversify their portfolios and risk and also jump on these opportunities. And it does raise, for sure, from an investor's perspective, it does raise a question of, will they be able to deliver? Some of them are still very, relatively young companies. They have not maybe scaled beyond the single market where they first established themselves. So yeah, I can allow for Ben to comment on that too, but it is definitely something that we are thinking about, and that ultimately, we can also deploy some TA support to help with.
Ben, go ahead.
I think you've said it all already, on this point. I'm not sure I've got anything to add on that.
Okay, so something interesting I want to speak on next is the role of partnerships. Eva spoke very briefly as well on how the regulatory landscape is looking. But who are the important partners that you're working with outside of just Camco and the developers that really feed into the ecosystem that you need to develop to be successful in what you're doing?
Yeah, maybe I can take this one, Eva. So obviously during the development phase, especially when we deploy the TA, that the advisors, right? So that will be the legal advisors, the technical advisors, and the environmental and social advisors. When we get to the construction phase and the structuring of the project, the co-financiers are very important. So that will be the co-lenders or the equity sponsors, the risk instrument providers, risk mitigation instrument providers, such as the political risk insurance or the guarantee providers. And then sometimes there is a financial advisor as well in the picture whose role is to actually bring everyone to the table and find the right structure.
Okay.
Yeah, absolutely. This just highlights, how much effort we need to invest in developing these partnerships. But on my side, maybe just to add on the sort of government and development partner side of things, as I mentioned before, I think that there are still too many silos, unfortunately, and it is really quite critical for us to work together. I think I can perhaps share one example to highlight how lack of collaboration can lead to some very unexpected outcomes. So, for example, in Zambia, I think in September 2023, I believe, there was the first statutory instrument released that basically is an executive order that completely deregulated the mini-grid sector. And of course, you can discuss for a very long time what led to this move by the government. They wanted to move fast. It's actually a government that has very strong political will. They want to see mini-grids being developed. They probably heard somewhere from the private sector that private sector doesn't like regulation, or that, we want like light-handed regulation. And they just took it all in and, they went and completely deregulated the sector. And when we first found out about it, we were really in quite a big shock, because not only did it create a complete vacuum and uncertainty, it also actually annulled or at least put into question the validity of the existing permits. So it was really quite a havoc. And it took so long to actually, come to some kind of a joint understanding with the government of why we want regulation. I think for them, it was so surprising that the private sector, and I work together with our partners at the African Mini-Grid Developers Association, or AMDA, to try to bring the message that actually, no, we don't want a complete deregulation. We need rules of the game. They just need to be efficient, effective, adequate to the types of investments that we're making. They cannot be the same kind of heavy regulations for mini-grids as they might be for, 500 megawatt IPP. But, the fact that the private sector was not consulted before that move was taken, or there was some maybe limited consultations in place, just led to this move that ultimately took us back, quite a long way. And interestingly, as of right now, I'm quite excited about this particular case, because it seems like we're finally developing this joint understanding, and maybe we'll see, a much more positive way forward. But it can show you how, lack of collaboration just really can slow down project development. And it's about just consulting each other, whether you are, government working on regulations, whether you are a development partner together with governments, perhaps developing a viability gap program, RBF program, whatever it may be, talk to developers, talk to their ultimately investors as well, because otherwise you might end up with something that may have very good intentions, but is ultimately not fit for purpose. And I think we don't have that. So yeah, it's really quite important to work together.
I wish I could echo that in every meeting before it starts. For the rest of the year. Very well said, Eva. We are running out of time. So the question we like to ask our guests towards the end, which we did prepare you for in advance, is with the work you're doing, with the massive ambitions behind REPP2, with the success you've had under the first fund, and with the development of the technical assistance facility, How do you define failure in your work?
I think it's pretty simple. It's number one, the operating assets on the ground, right? And the impact that it creates. That's something that we track closely. And then, because if we don't deploy into projects that are actually end up being built, then there's just no impact. And so our work was useless. And then number two, it's obviously the returns to our investors. So deployments and asset build, which leads to KPI and impact, and then the returns.
I mean, I would echo what Ben said, because of course that, delivering on these aspects is what will help us show a good track record and expand the work, expand finance mobilization. But I think, for me personally, you could have got the message already. I think what I get really most frustrated about is when people work in silos. And because I do think that we lose a lot of time that we don't have by sometimes even competing programs, sometimes just failing to, get someone's input, even bringing the different actors together, like bringing investors closer to the REPP programs, to deploy faster, to help developers access both types of funds faster. I think there's a lot more that we can do there. And maybe just an additional thought to this end would also be that another kind of failure that I would see is that we would only, sometimes when we focus on sort of maybe climate dimension or even just the energy access dimension, we forget that ultimately it's about sustainable development. And so making sure that that we're delivering on both of these agendas, and we see the interlink and the crucial interlink between the two for the sustainability of these projects and for the ultimate impact, would also be a failure from my perspective.
Thank you so much for joining another episode of the Energy Talk podcast. If you did enjoy the episode, please don't forget to share with a friend or colleague, and make sure you're following us wherever you're listening. Have a great rest of your week, and until the next episode. Bye-bye for now.